Welcome back to Market on Close. Let's talk about some of the discussions happening in public companies about going private. We might be losing some names here. Joining me, the guy Erik Hirsch, the co-CEO at Hamilton Lane. Erik, thanks for being here on the Schwab Network. Tell us about what you guys are doing at Hamilton Lane, and as public traders and investors, what we can glean from that.
So thanks for the invitation. Appreciate being here. So Hamilton Lane is one of the world's largest private asset managers. So we are helping both institutional as well as individual investors access the private markets. And as you noted, the private markets continue to get sort of more exciting. They're growing, and the opportunity set remains very attractive.
Seems like a lot of the discussions that we've been seeing in publicly traded companies is about finding potential private market suitors, I think namely about Paramount. And then at the same time, there was a lot of hope that there were going to be a bunch of IPOs this year. It's been pretty muted. I feel like those two things are related. How come?
I think there's a couple of reasons. I think being a publicly traded company, and I know because we are one, is not fun. It is time-consuming. It is expensive.
Well, your guys' stock is at the highs. We got your chart up right now. It's looking pretty fun.
It's been, I mean, the stock results have been terrific. Running the publicly traded company is not always fun. But I think fundamentally the public markets need to start thinking a little differently. I think we're in sort of a paradigm shift time here where we got to think about longer time horizons. I think the public markets are so fixated on sort of day-to-day change or quarter-to-quarter change that if you're trying to kind of run a business strategically for the long term, sometimes quarter-to-quarter changes is not how you want to manage that business. And so I think what we're seeing is a number of frustrated public companies who want to become private again to give themselves that flexibility.
Does any of that pressure ease if capital markets do ease, if rates come down? How much of that pressure as a public entity does arise when you have some macro pressure?
I don't see it changing. I think if we were to show a chart that sort of showed the number of publicly traded companies in the United States, and we went back into the 80s, and then we ran that chart out today, it is basically a drop down into the right chart. The number of publicly traded companies is shrinking, it's not growing. And so I think that trend line is not in the public market's favor, unfortunately. And I think what you're going to see is the private markets continue to do what they're doing now, which is continue to amass a lot of capital. It's also causing investors to shift the way they think about building their portfolio. We've always kind of been growing up and sort of taught public markets are safer, private markets means venture capital, it means illiquidity, it means a lot of risk. But I think investors are sort of looking at data and they're taking a different perspective. I think one, liquidity and the desire for liquidity is actually dropping, not rising. And the outperformance of private markets versus public has been substantial. And so I think people willing to sort of take that illiquidity trade-off for much, much higher performance, and again, thinking longer term.
And where's the evidence that the performance will be stronger in private markets for some of these companies that we've been discussing lately? Again, the Paramount move, kind of one of them. Give me kind of an example of like why a business like that might function better private. Is it just because they've got too many cooks in the kitchen right now? I know it's a very specific example, but kind of the reasoning behind why that performance you think would be enhanced.
Yeah, if we widen out that lens and you look at private equity performance versus public equity performance, and you take that over a 5, 10, 15, 20, 25-year time period, the outperformance is there, the outperformance is consistent. Even when you adjust for fees and all the other things that we should be adjusting for, that outperformance is real. So then the question is, well, why? And is it sustainable? I think it comes down to a fundamental point, which is very simple alignment of interest. When private equity arrives on the scene and buys a business, they economically align with the management team. Management team comes in at the same price as the private equity owner. Management team's compensation is aligned to those results. As you noted, not a lot of cooks in the kitchen. One owner really focused on driving results over a kind of 3 to 6 year time period. And in that sort of simple world where people only get paid if they exit a business profitably, you see really good results. How many days do we open up the newspaper and see public company X, whose stock has been dismal, and yet the CEO has gotten some incredibly lucrative pay package? That's a problem in the public markets because ownership is so disparate, it's hard for investors to have a big voice.
Are there any particular areas that you see are ripe for private takeover at this juncture? Even if you can't talk stock specific, are there characteristics that overlap between the companies that are the best candidates so that we as investors can kind of like have our own kind of screening? What's like the elementary version of what you guys do?
Yeah, so I think there's a couple of things to look for. Obviously, right now, if we look at the public markets, it's sort of a tale of two cities. It's got a small number of largely tech-oriented businesses, as I'm sure you discuss all the time, that are pulling the market. But that means there's a whole bunch of businesses, particularly if we move into the small and mid-cap businesses, that are not profitable and need time to become profitable. So the places I would be looking for screenings are, one, just fallen angels, so businesses that have seen their stock price come way off and have a shareholder makeup that will allow for a take private. And the other place is businesses that are just generally falling out of favor as the market in the public side continues to look for hyper growth. Basic businesses, basic manufacturing, basic industrial sometimes become not so sexy in today's market, and they become another good area ripe for takeover by a private equity business.
Okay, like that, helpful. Erik, what if the public debuts stay kind of slim? What if the IPO market stays muted? I mean, certainly today looks like we're like opening the door to a big new risk asset kind of frothing, but let's say that it stays muted. Does that limit the potential outcomes from the private market if the goal is eventually to bring companies public back around the other end, or can you do what you need to do fully private, or do you need that IPO outlet?
It's a great question. So I think if we dial back 15, 20 years, you really needed, for sort of large private businesses, you needed the IPO market. You needed an environment where, hey, once I get to a certain size, the only way for me to get liquidity for shareholders is to take it public. And that was really seen as kind of the capstone event of you made it. You made that business successful, and the reward was you're now a publicly traded business. Those days are over. The private markets are so big today, and there are so many competent buyers that what you're seeing is an enormous amount of trading one asset to another. Now, again, the myth on that is, well, the prior owner must have stripped out all the value, so who would want to own it again? Again, let's go back and think like stock pickers. You could have owned Microsoft for a whole variety of time periods over the last 30 plus years and made money. That business has changed, it has evolved, and it has rewarded shareholders, again, in different time periods with good results. So that's what's happening in the private markets. Buyer X owns a business and they have it for 3-5 years. They sell it to buyer Y, who owns it for another 3-5-6 years. They both do different value-added things with that business. They both generate good results. They both can achieve liquidity, and they don't need the public markets to do that.
All right. So far, it seems like at least in the last 52 weeks, you guys have been able to thread that needle. Stocks up like 80%. Erik, thanks for the introduction. Looking forward to continuing the convo. Appreciate you being here.
Enjoyed it. Thanks so much.
All right. Absolutely. Erik Hirsch, co-CEO at Hamilton Lane, ticker HLNE.